The exchange trade product industry saw flows hit $35.4 billion in April. That's twice the previous month, according to BlackRock's ETP landscape report. Flows into global fixed income hit the highest level in 10 months. Varia Pechurina is Vice President of BlackRock and joins us now with some more. Welcome. Clearly April was a standout month. What was it that made it so much of a month to applaud?
Yeah, you know, if you had to ask me what was the most notable ETP flow trend that we have seen in April and why this was such a remarkable month, I would say that's the fact that commodity exposures have gathered the majority of inflows. Now, why am I saying it's so surprising? If you think back to the beginning of the year, back then it was all about equities. So I think we had a record year of inflows when it comes to EMEA ETP industry. And that because the sentiment back then was super bright. So if you think about equity market rally, people were super enthusiastic about global growth, strong earnings. And this picture has shifted. Right now we're really facing mixed risk sentiment, and it was gold that was gathering the majority of inflows in April because of trade uncertainty, because of the fact that investors are worried about peaking US corporate earnings, and potentially the risk that the Fed may need to raise rates more quickly than we're expecting it right now.
What about equities, though? Was there any evidence of any pockets of flows into equities in the month of April?
Yeah, so for equities, it wasn't all that bad. In fact, the only bright spot that I would like to highlight is US equity exposures. And in fact, EMEA investors have been quite persistent going into US equities, and we have seen inflows into US equity ETPs for 12 consecutive months. And this persistency is actually quite remarkable, because if you look at US investors, they have been quite tactical about allocating to their domestic equities. So we have seen strong outflows in February, and then these outflows are now coming back. But EMEA investors have been really had a strong conviction about US equity exposures throughout all these months.
What was it then about US equities that made them so interesting? I mean, were you surprised about this inflow?
Yeah, not overly surprised. In fact, US equities is one of our top BlackRock equity convictions alongside EM equity exposures. And the reasons for that are really twofold. The first reason is macroeconomic strength. So we're seeing all these data releases, non-farm payrolls, retail sales, all of that are really pointing to the fact that US growth is really strong. Now, on the second reason, it lies more in micro fundamentals. So we're now in the end of Q1 earnings season, so it's kind of quite a good time to take stock of how US corporates have reported. And the results are really impressive. So the EPS growth on a year-on-year basis is around 24%, and it's a number that we haven't really seen for years, so since 2010. So all of that, and while we don't expect this earnings strength to persist at such high levels simply because it's just a really high bar to clear, we expect them to remain quite strong simply because US growth is remaining resilient, and US corporates are now flooded with cash after tax cuts, so they can do more buybacks, which will ultimately should continue feeding through into corporate bottom line.
This is a bit of a change from last year. I remember talking to BlackRock this time last year. European equities were the favoured place to be rather than US. So what's been the turnaround? Are European equities in any way, shape or form still an investment opportunity?
You know, in terms of flows, the picture for European equities was quite depressing recently. A very sharp contrast to US flows that we've just discussed. And the turnaround moment for that was March, so this March, and we have seen in EMEA, across EMEA ETPs, we have seen outflows from European equities, which then exacerbated in April. And while we probably, from investment strategy standpoint, are quite surprised by the extent of outflows, simply because if you look at the price action, it wasn't actually all that bad for European equities. We're kind of not surprised that investors prefer US over Europe. And all these drivers that are so bright and so good for US equities, they're not really shining as well for Europe. Growth has been slowing down, well, proxied by PMI data recently. And earnings haven't been as stellar, so we have seen some slowdown, and in particular, earnings don't look as good as US earnings. And that's kind of a consequence, partly, of the fact that the euro has been strengthening last year.
What about fixed income, Mark? Are you seeing any risk-taking there?
Yeah, so in the fixed income space, it was all about rates. So for 3 consecutive months, the majority of fixed income inflows went into rates exposures. And within that, it was short duration that were really standing out.
What about the strong demand for rates exposure? What's been behind that?
Yeah, so we see two reasons for that. The first one goes back to risk sentiment. So all this uncertainty around trade, global growth prospects, all of this uncertainty that's been driving inflows into gold, we feel the same drivers were really driving flows into rates, which is also a safe haven exposure. And the second reason lies in the level of yield that you can get in short duration rates right now. So previously investors were penalized by holding safe haven exposures, by holding rates because they couldn't get a level of yield that would exceed inflation levels. And now that's not the case anymore. So now you can get the yield above inflation, which essentially means that rates come back online as a competitor for investor capital, and hence flows that we're seeing in the ETP space.
Yeah. Okay. All right. Interesting story. Thanks indeed for updating us on ETP flows. That's Varia Pechurina, Vice President at BlackRock.